From Miami Law, I'm Annette Uguez, and this is The Explainer.
If you, took a course on Investing 101 maybe 5 or 10 years ago, they would have told you this is the best way to invest because you are paying low fees and you're getting exposure to the entire market. Well, the problem is that you're not getting exposure to the entire market today because you're getting exposure to those top 10 stocks.
Welcome to Season 15 of the Miami Law Explainer, the legal affairs podcast where University of Miami law experts lend context and historical relevance to today's headlines. Corporate law expert George Georgiev has written extensively on private capital markets and recently participated in a meeting of the U.S. Securities and Exchange Commission's Investor Advisory Committee, which issued a major report and recommendation on retail access to private market assets. On this week's show, we dig into this topic, which has implications for how all Americans save for retirement. Let's go to executive producer Catherine Skip with the interview.
Good morning, George.
Good morning, Catherine.
Hey, welcome to the School of Law and welcome to The Explainer.
Thank you.
First, can you give us a quick primer on private market assets?
Absolutely. Private market assets, also known as alternative investments, have been around for a long time, but they have been getting more attention recently, in part because they have been the subject of regulatory attention and perhaps more aptly, deregulatory attention. So private market assets, what distinguishes them from public market assets is that they're not traded on the public markets. Public companies are traded on the public market, and that has the advantage of transparency. We are pretty sure that the valuation or the market price is more or less accurate. They're more liquid because there's always a buyer and a seller, and in fact, that determines the price. By contrast, private market assets, alternative investments more broadly, are not traded on liquid markets. There are many questions about their valuation, and they are not subject to the same level of transparency as public market assets. So if you think about the public market assets as the gold standard, but perhaps maybe more boring these days and perhaps offering lower returns. Well, private markets are the opposite of that. They're much more exciting, but as I guess we'll discuss, they also carry a higher level of risk potentially.
Sure. And
just to give you some examples.
What defines those? Yes, exactly.
Yeah, just to give you some examples. So private companies, the stock in private companies is a private market asset or alternative investment. We have now over 600 unicorns in the United States, which makes you wonder whether the name unicorn is apt. But what is a unicorn? It's a private company with an implied valuation over $1 billion. And when the term was coined in 2014, we only had 14 of them. So it was much more apt in 2014 than it is today. So the stock in those unicorns, that's a private market asset. Infrastructure funds, also private market assets. Various crypto investments, private credit, and various derivatives and securitized products based on private credit are also private market assets. So anything that is not your plain vanilla public company stock.
Right, not your IBM stock.
Yeah, not your IBM stock.
Okay. So in this meeting that you had at the SEC that we talked about at the Open, the recommendation highlights the rapid rise of private capital markets as a key reason for this regulatory review that you're speaking of. For our listeners who mostly invest in vanilla public stocks, can you explain what has changed and why they should care about accessing these private markets now?
Yeah, so that's the trillion-dollar question. The reason I say a trillion-dollar question, perhaps $50 trillion question, is because there is just a lot of retail money out there that can potentially be channeled from the public markets to the private markets. And the reason we're focusing on the private markets now is because as a result of various changes over the years, which we can talk about some other time perhaps, the private markets have become much more prominent. There's just a lot more of these private assets, and the big asset managers, Vanguard, BlackRock, State Street, Fidelity, they're much more focused today on providing Main Street retail investors with access to these markets, again, as a reason to diversify and as a reason to get more exposure to perhaps higher growth or higher yielding assets. And, let me just say something about the problems with the public markets, I guess, and what is, which is one of the big reasons why we've seen the rise of attention and the shift to private market asset investing, and that is that we just have a tremendous amount of concentration in the public market. So the top 10 stocks account for 30% of the market cap of all public companies. So if you want to diversify, it becomes very difficult, because if you just buy a market cap weighted ETF that represents
an ETF?
Exchange traded fund. So think of it as just a basket of securities that that represents the entire public market. And this is the way that if you take a course on Investing 101, or if you, took a course on Investing 101 maybe 5 or 10 years ago, they would have told you this is the best way to invest because you are paying low fees and you're getting exposure to the entire market. Well, the problem is that you're not getting exposure to the entire market today because you're getting exposure to those top 10 stocks. 30% of what you're getting exposure to is NVIDIA, Microsoft, Apple, Alphabet, Google, Amazon, Meta, and Tesla, the Magnificent Seven, which are plays on AI tech and somewhat speculative plays, even in the public markets, right? And so the fact that the public markets have become so concentrated is part of the reason. And if you want to diversify, if you want to invest in something other than tech, you're kind of out of options in the public markets. That's one of the reasons why we are looking at infrastructure, crypto, private credit, and private companies of various flavors. So that's kind of how we got there. Now, the Investor Advisory Committee of the Securities and Exchange Commission has been thinking about these issues for a long time, and it's a tricky question for us on the committee because how do we balance investor protection, which is really what the committee is there to safeguard, with investor access and investor opportunity, because investor protection implies steering investors away from those high-risk assets, potentially high-risk assets, right? And one of the problems with alternative investments or private market assets is that because of the lack of transparency, because of the difficulties with valuation, it's actually very difficult to know what they're worth. Right. And we saw this just a couple of weeks ago with the private brands bankruptcy, where this company that everyone thought was a great auto parts company basically filed for Chapter 11 bankruptcy because it turned out it had a lot of balance sheet arrangements and it was a lot of smoke and mirrors, if you will. So that is
Elizabeth Holmes.
Well, yes, and of course Elizabeth Holmes and Theranos, right? So that's another example where even though you had a lot of sophisticated people investing in the company, a unicorn, by the way, a unicorn company at the time, a lot of sophisticated people on the board, the company didn't have proper financials. There was a lot of fraud in the company and wasn't really subject to any appropriate level of scrutiny that you will hopefully see in the public markets. Now, the public markets are not perfect by any means, but it's part of conventional wisdom now that private markets are riskier, less transparent, and more problematic. Right. And so you would wonder, well, if they're so problematic, why did this SEC Investor Advisory Committee decide to look into a recommendation about expanding investor access into private markets? And that's a great question. And, one of the reasons is that we're moving in that direction regardless of what our SEC Advisory Committee recommends. And so part of the challenge for us was to decide, well, how do we balance these goals of investor protection with capital formation, with providing retail investors with additional ways to diversify, right? Because we recognize that public markets do not provide. They may be the gold standard, or maybe they were the gold standard once upon a time, as we talked about, but they don't provide enough diversification opportunities today, and that is a problem. And maybe we can do some things over the long term to fix public markets, but we're not going to do that overnight. And in the meantime, retail investors, mom and pop investors need, and they have been out there telling people that they need or they want additional investment opportunities. And so we looked at the various options, and one way to give that access is by enhancing direct access, so allowing retail investors to buy stocks in First Brands or Theranos, while it was around, or WeWork while it was a public private company before it became public, and it went through its own bankruptcy roller coaster. But that's one way. But we, in our recommendations, say that this is a riskier way, and the better way is through registered funds, which combine oftentimes public market assets with private market assets, and in that way you get built-in diversification. So you're not buying a piece of the entire public market. You're buying a piece of the public market with a piece of some private markets built in there, and that gives you that additional exposure to private market or alternative assets. But it also gives you the protection of what we have in the public markets. And so that's how we got there. And and I'll also say that I already alluded to this, that kind of we're moving in that direction regardless of what the investor protection community or investor advocacy community may be recommending. Why? Well, because we had an executive order by President Trump in August of this year, where he urged both the SEC and the Department of Labor to basically take steps to expand 401k investor access to alternative investments. And so that's, again, our private companies, infrastructure funds, crypto, other illiquid assets. And so the SEC, not the Investor Advisory Committee, but the SEC, once we emerge from the shutdown that we're currently in, and the Department of Labor will be looking, and they're already kind of on the, they have been thinking and looking at ways to expand this access. So this is coming, and the really big question is, how do we do it? And there are good ways to do it, and there are less good ways to do it, or there are less bad ways to do it, depending on your perspective. And our committee issued this 26-page recommendation, identifying the trade-offs, identifying the challenges, and focusing on some of the less bad ways to do it.
So you were talking about like strongly favoring registered fund as the optimal way for retail investors. So what is the biggest risk for a small investor who might try to invest directly in a private company, bypassing one of these funds?
Yeah, so the biggest risk is they would put all their eggs in one basket just because the stock is very exciting, right? Because Theranos before
GameStop,
it went, GameStop. Well, GameStop was slightly. It was very exciting. It was a meme stock,
but it was a real. Stock,
it was a public company. Yes, but the Theranos before it went bust was a very exciting stock, and probably just when you see Elizabeth Holmes on the cover of Fortune and getting all this terrific press coverage and this technology which promises to revolutionize many aspects of healthcare. Of course, everyone wants a piece of that, right? Because that's going to be promises to be a high growth stock. And the risk is you're going to put all of your money, if you have access to that, you're going to put all of your money into that one basket, which then subsequently turns out to have been fraudulent, and you would have lost your nest egg, right? And so if we allow 401k investors, if we allow investors saving for retirement or retirees to put all of their money in these directly into these stocks, that's potentially problematic because of fraud. Because of illiquidity, they may not be able to get out of those stocks just because there isn't a liquid market for them. Because of the fact that they don't trade on public markets, there is less certainty around the valuation, there is less transparency, and so on and so on and so on. So that's the big risk for direct access.
It's like trying to unhook your cable company, right?
Right.
Sorry, please go be on hold.
Yeah.
the recommendation suggests that if direct access is expanded, there should be prudential limits on how much a retail investor can put in, like you were just discussing. So how does the committee balance the goal of protecting the investors from major losses with the idea of giving them the freedom to participate in potentially high growth opportunities?
Yeah, I mean, and that is a difficult question, and the committee kind of punted that issue a little bit. Why? Well, because we don't have enough data, right? And we acknowledge that. And by we, I mean not just the committee, but just the corporate governance, securities law, investor protection community generally. And we need to think more about this issue. We need to study the issue. We need to hear from investors. We need to hear from other market participants. What are the right limits, and to set those limits at the right levels. But there need to be some limits. We can't, as I just said, we can't allow investors to put all their eggs in one basket. Now, even under the current regime, if an investor is a so-called accredited investor, which is a fairly low threshold, they would be able to put all of their eggs in that one basket. Which just brings us back to the importance of registered funds, because they benefit from SEC review, from additional protections on the investment
Some
company
guardrails,
Act.
right?
Yeah, exactly.
Cool. Anything to add in closing?
Well, none of this is investment advice, first of all, but it's an issue that we'll be hearing more and more about, because I think the fact that the public markets are not working the way they worked in the past.
Right, the dogs of the Dow, the whole how you set things up 20 years ago.
Exactly. That is a fact, and so we have to start thinking outside the box, and it's a little scary when you start thinking outside the box,
Called progress. It's called progress.
Yes, progress. But registered funds, for all the reasons we discussed and others, are one way to do it. And the recommendation goes into great detail in all of this, so our listeners can go on the SEC website or the links to this episode and download it and read all about it. And I hope we'll talk more about this down the line, because it's a live issue, it's a moving target. And First Brands with its bankruptcy. If I had to predict, I don't think it's the only one. I don't think it's an isolated case.
Right.
And so we're going to see more problems in these private markets, and that's a real risk that investors have to keep an eye out on.
Fascinating. Thanks so much for coming in.
Yeah, thanks for having me.
All right, see you around.
Thanks for joining us for another episode of the Miami Law Explainer. If you enjoy our show, leave us a 5-star review with your podcast provider and ask your friends to subscribe. Our show is engineered and edited by Christopher Alzadi, with theme music composed by Rady Kim from the Frost School of Music. I'm your host, Annette Uguez.